Okay, good morning. We are starting on chapter 2 today. I'll go till about 10, well, we'll take a little bit of a break because who really wants to talk or listen for 2 hours? So we'll take a little break and stretch. And then I'll stop about 10 minutes to 12 and answer any questions you might have on the tax returns. And then we'll continue on from there. So what we're doing in this chapter primarily is understanding all the elements of gross income. And if you remember the tax formula, where does gross income show up? Yeah, it's at the very top. So we start with gross income. That's the very first number that we adjust everything from. Basically, and I've said this before, gross income, everything's gross income unless it's specifically excluded. So what I'd like you to do at your own leisure, i.e. part of your homework, is look at page 2-3 and for the list of inclusions and exclusions. So what we're really going to be talking about today is how are some of these things that are included, there's some tricky pieces to it that we sort of need to identify how we determine what amount is included. IRS specifically tells us that barter transactions are includable. So I do your tax return and you cut my hair, and we both need to declare that as income.
And now how does that work for using it as a tax deduction? Like I know one of them can use it as a business deduction, right?
So if I did your tax return and you cut my hair or gave me goat meat, you would have to declare revenue. Do you butcher your goats?
Yeah.
Yeah. You would have to declare revenue for the sale of the meat. I would have to declare revenue for providing the service of the tax return. But you could write off the cost of the tax return because that would be a business deduction for you. We would invoice each other. It's just cash wouldn't change hands.
But now yours is a business too.
Right, but goat meat isn't a deduction to me, whereas doing taxes is a business deduction to you.
Okay, so I can use that, if it's $300 value, I can use that
as a deduction. The IRS now requires that wages paid using virtual currency, have you guys heard of things like Bitcoin, right, where you exchange money in a virtual environment, digital environment, you've got to issue a W-2 for that. So if I'm paying you using Bitcoin, that is taxable wages. Okay, interest income. What schedule does this go on again? Schedule B. And let's go ahead and take a look at a Schedule B. I'm going to run and get my glasses. You guys find one, please, in the back of the book.
It's in the back, but I also put on it 2-7. Yep.
E7. I know E7 has one too. 27 has one.
Did y'all find one? Probably either in chapter 2 or at the back of the book. Okay, 2-33. Or wherever you are, as long as you got one. But if you don't have one, you can go to 2-33. So you only need to do a Schedule B if your interest income is over what? What do you do if your interest income is $78 then? You don't have to pay tax on it?
Do you declare it, but you don't pay tax on it?
You just put it straight on the 1040. So looking at the B and looking at a 1040, what line does it go on the 1040? Line 8, right? Okay, what page are you on for the 1040? D11. Okay, good. Yeah, and then the A and the B and everything's right after that. So your interest income goes straight onto line 8A, except for we have this thing on 8B called tax exempt income. What does that mean? Something you don't have to pay taxes on. So we're going to learn about a type of interest that you don't pay taxes on. Now, stick with me here. So you have to report all interest income. If it's less than $1,500, it's just going to go straight to the 1040. If it's more than $1,500, it's going to go on your Schedule B, and then the number from the bottom of that's going to carry to line 8A. So interest is always taxable, but you only do the B if it's over $1,500. Government bonds. Anything that is backed by the full faith and credit of the United States government is called a government bond. And even auxiliary government agencies like Fannie Mae or Freddie Mac or Sally, what's that called? Sally Mae. Right, all the mortgagors that repackage and resell our debt. That's also government bond interest. Basically, the three biggies are double E's, double H's, and I's. And they work a little bit differently each. I'm not going to spend a ton of time on that, but what you need to know about them is that you don't pay tax on federal bonds on state income tax returns. So if you go look at your manual recap, I'll give you a second to find one on the Montana page. Tell me what you think I'm talking about. You haven't really used any of those reduction or addition items yet on your Montana manual recap? Yeah, it's right there, reduction. Exempt interest from federal bonds. So if you've got some double E bonds and you earn $900 on them, is it taxable on your 1040? Yes. Is it going to show up in that federal AGI number on your Montana tax return then? No. Really? Doesn't your federal AGI number on your Montana tax return always have to balance? Yes. And then after that number, you're going to see minus Montana reductions. And this is the first example you've seen or learned about of a Montana reduction. So you're going to have to pay attention to that, aren't you? And I can guarantee you when you go into the software, there's going to be a special way you have to input that to tell the software that this income is a reduction on Montana. So, and everybody understood what I was just talking about, right? When I said it's not just double E's, double H's, and I's. It's Freddie Mae, Fannie Mac, anything that I tell you is a government auxiliary or a government-bred organization, not taxable in Montana. Oh, and let me back up. What are you going to get in the mail that's going to indicate your interest income? Right? 1099 INT. Dividends. What are you going to get in the mail that tells you about your dividends? There you go. There's three kinds of dividends, and they're treated differently. We need to look at our 1040 to figure out where they go. Ordinary dividends. How would you guys define a dividend? Yeah, it's the return of profits to the shareholders, isn't it? So that's taxed to the shareholders, ordinary dividends. What line are those going to go on? 9A. Then you've got this idea, and I'm going to back up. I'm just kind of following the tax return now. 9B of qualified dividends. And your 1099 div will very clearly label them as qualifying dividends. Those dividends, you guys, and we saw this in chapter 1, so this is a reinforcement of a concept you've already learned, are taxed at different rates, aren't they? So if I'm in the 10 or 15% bracket, how much do I pay on my qualifying dividends? None. If I'm in the 25 to 35% bracket, I pay 15%. And if I'm in the highest income tax bracket, I pay 20%. But at any rate, I'm always going to pay a whole bunch less on my qualifying dividends than I do on my regular income. Yeah? If they're not qualifying dividends, and again, this is going to be right on your 1099 div, so it's all about getting them input correctly, then they're going to be taxed at ordinary rates. The brokerage house. And there's a bunch of rules that tell you whether they are or not. So this is going to present something tricky when you go to your taxable income on your manual recap. Why? What have we been doing until now? You get your TI, and where do you go? Carissa, how do you find out the tax once you get your taxable income? Where have we been going? Yeah, you go to the tax rate schedules, right? And if it's under 100 grand, you just pull it off. If it's over 100 grand, you got to calculate it. Anybody see where this is going to throw a loop in that easy peasy thing we've been doing up till now? Yeah. Yeah, you can't do that anymore if you've got things that are taxed at different rates, can you? So I've got, you can go ahead and write this down, TI equals 88,000. TI equals 88,000. I'm head of household. TI equals 88, I'm head of household. And of that, $2,000 are qualifying dividends. How are you going to figure out my tax bill? Okay, good. Yes. TI is 88,000. 2 of that are qualifying dividends. Can you go straight to the tables anymore? Yep. You've got to go find the tax for the 86, figure out which tax bracket that's in, and then go to the little chart that says if you're in the 25 to 35%, you pay 15, or if you're in the 10 to 15, you go to 0. Or if you're in the 39.6, you pay 20. Does everyone know what they're doing? Try and find the tax bill for me when you've got staggered income. In other words, everything's not at the same ordinary tax rates.
Well, you have to figure out what right?
Head of household. How much is the tax for 86,000 per head of household? Go ahead, Gretchen, what is it?
15,919.
What's her highest marginal tax bracket? 25%. So I have to go back here and say if I'm in the 25 to 35, what do I pay on my qualifying dividends? 15%. Right? So we can no longer, if we have things that are taxed at different rates, just go straight to the tax tables to predict our tax, can we? Okay.
Where's that chart?
When I was looking at it, when I went to the tax rate schedule and just
Is that in your
wrote
book?
86,
You can do that.
and that told me
Yeah,
that
yeah.
25%.
Yeah.
So that's okay.
Oh, yes, that's exactly what you have to do. Otherwise, you wouldn't know.
Is that chart in our book by chance, you know?
I don't know. I just made it up and put it in here.
What did you just
It's got to, yeah, it's got to be in your book. Sure, it's got to be in your book somewhere. Are you okay, ladies? Did you see what we did? Okay, where was the breakdown, Mel?
I got
Okay, so then what happens to that other 2,000 based on this chart of qualifying dividends? What's this chart tell you? Yeah, you've got to go find this, don't you? Do you know where to do that? That's in the tax rate schedules at the beginning, yeah? So you're going to go and find head of household, 86,000, and then it's going to tell you the tax is X plus anything above Y is 25%. And that tells you, that number tells you she's in the 25% regular tax bracket. Then you can come over here, find this number, and say, oh, that's what the other $2,000 is taxed at. Okay, is everybody okay with that? So I'm kind of going back and forth here, but at any rate, I wanted to make sure that you understood ordinary dividends, okay, that's great, but a lot of times ordinary dividends are qualifying, and then you've got this whole additional thing. Okay. You only do a B when they exceed 1,500. Okay. But they're always taxable, again. So if you had, $18 of them, they go straight on the 1040. But you got to input them correctly. If they're qualifying, they're going to be taxed at that lower rate. Non-taxable distributions are a return of your original investment. It's basically when a corporation's in liquidation. Those are very rare. But if they are, they're not taxable. They reduce the basis in your stock, and there's a special way to enter them in the software. So what am I telling you? You've got ordinary dividends. You've got non-taxable distributions. Some of these may be qualified. And many times they're going to be capital gain distributions, CGDs. Those are also taxed on the tables rates that I just showed you, like this. Alimony. I'm just going right down the 1040. So what line are we on the 1040? That's alimony paid. We're doing elements of gross income, so we're on line 11, alimony received, right? What line have we skipped in the gross income?
Taxable refunds for.
Yeah, taxable refunds, and I think I need to talk about that. There's not a slide in here. Actually, let me finish something about the interest. So, I think you should probably put this in your notes. So, taxable for the 1040. Is it taxable for the MT2? Okay. So the question is, I'm going to give you some different kinds of interest, and I want you to tell me where you think it's taxable. So, regular corporate interest, right? So I've invested in, GM bonds, and I make $2,500 in interest income. Is that taxable on my 1040? Yeah. Is that taxable on Montana? Regular corporate bonds. Yes. Nothing special about it. So you don't, are you going to have any addition or reduction on Montana? No. Okay, then let's say I get a U.S. government bond. And I get $2,500 interest. Taxable for the 1040? Yeah. Taxable on Montana? No. So what do you have to watch for on your Montana tax return? A reduction, and I came up with that word because I looked at my manual recap. There's additions and reductions. Yeah? Now I'm going to tell you something that you don't know, so I'll fill this part in. What if it's a state bond, like a Tennessee bond? So it's a Memphis wastewater treatment bond. And it pays interest. And I invested in it, and I got a check for $2,500. First thing I'm going to tell you is you don't pay interest, or you don't pay taxes on interest on state bonds at the federal level. You don't pay taxes on your 1040 on state bonds. And that was that little caveat on line 8B, tax exempt interest. That's exactly what this is. It's interest, but it's exempt from federal taxation. Yes. And if it's a Montana state bond, like I bought a Montana highway bond, or what did we just issue here in Missoula, open space bonds? So if I bought some of those, I'm never going to pay interest on it anywhere. If it's a Montana bond, it's not going to show up in my AGI anywhere. So who's excited to buy bonds? Everybody, because you don't pay taxes on it. Are they more valuable to low income or high income people? Why? Yeah, if you're in the 39.6 bracket and you're not paying tax, that's a hell of a lot more beneficial than me in the 10% bracket, right? These are very attractive to higher income people. In Montana, though, they say, okay, so you bought the Memphis wastewater treatment bond, right? you got a check for $2,500 and it doesn't go on your 1040, what do you think Montana says? You've got to pay tax on it in Montana. So what's that going to be on your Montana tax return? It's going to be an addition. And I think, hopefully, that's in your addition column.
That's the non-Montana.
What does it say? Oh, munis, municipal bonds, munis. Sorry. Muni bonds, yeah? If you don't understand something up here, let me know right now, because this is, a huge chunk of the tax returns for Chapter 2. The key is getting them put in so that they show up where you want them to show up. Okay, questions?
If you move out of the state of Montana, does your Montana interest that you get from this bond that you still own become taxable in the state you live in?
It depends on their state law. But I would say, yeah, probably. Most states aren't going to subsidize muni bonds in another state. Okay. And then the other line that was right below that, I think on line 11 or something, is that where we were for the taxable refunds, or line 10? For most of us, it's going to be our SIT refund from prior year. So on my 2014 tax return, I got a $986 SIT refund. So the next year, I'm going to have to pay federal taxes on that, but only if I itemized it. Only if I got a tax benefit from it. Only if I itemized it. If I don't itemize my deductions, then when I get my refund, I don't have to pay tax on it. But if in the prior year I did a Schedule A and I itemized my SIT and I got a tax benefit from it, then in the subsequent year I get a refund, then I pay tax on it. Is anybody ready for that stretch break yet?
Yeah, I have no idea what you just said.
So I know, I was kind of a collective like, So in 2014, I filed Schedule A. What's one of the things that's going to be on my Schedule A? Just name anything. Anything. What's on my Schedule A? What do I itemize? Mortgage interest. What else?
Student loan interest.
That's a deduction for AGI.
Medical.
My medical.
Charity.
My charity. This is where my taxes go, my property taxes, my state income tax. Right? All those things I itemize. And if my itemized are more than my standard, then what do? I take my itemized. So I itemized. And my itemized deductions came to $21,000, which is way more than my standard. And one of those things that was on my Schedule A that came down to that $21,000 was SIT of $4,000. That came off my W-2. That's what was withheld off my W-2 in the prior year, right? So I go down the road. I do my federal tax return all the way through. And I do my Montana tax return. And I get a refund of $811. I'm obviously not going to get back all of my $4,000 because part of that the state keeps. So I get $811 back. The question is, in 2015, is that taxable on my 1040? It's taxable on my 1040 on line 10. How come? Because I itemized in the prior year.
So if you do itemize, but you don't put your,
Well, you always would put your SID. You maximize your itemized deductions. Now say in the prior year, second situation, I have my SID of 4,000 and I add all my stuff up and it comes to 5,900. My itemized deductions. Am I going to itemize? Yeah, because I married filing joint, 12-4 is more than 5,900. So I do my Montana tax return, I get my $811 back. Is it taxable on my 1040 in the subsequent year? Not taxable, because I didn't get any benefit out of it the prior year. And it works the same for Montana. If you itemized FIT in a prior year, and then you get a FIT refund, part of that's going to go as taxable income on Montana, and that's in your additions column. But that gets a lot more complicated, so we're not going to get into that quite yet. Because we're only on the third slide here. Okay, alimony. Alimony is deductible to the man or woman that pays it, and it's taxable to the person that receives it. The deduction is down there on line 31. Deduction for AGI. So if I pay my ex-spouse alimony, I've got to write down his Social Security number and the amount I paid him, and then it better show up as revenue on his, as gross income on his tax return, right? I get the deduction, he pays tax. It's got to meet 5 requirements in order to be considered alimony. It's got to be cash. It's got to be made in connection with the divorce instrument. It can't continue after the death of the spouse, because then it was really child support. It can't be called anything other than alimony, and you can't live together. This is more complicated than I want to get into. Okay, let's take a look at this. Complying with the written divorce decree, Frederick pays Shauna $1,800 a month. The decree specifies that the payments will be reduced 40% when their daughter, in Shauna's custody, becomes 18. What is Frederick's annual deduction per year as alimony, and Shauna's annual taxable income as alimony? Oh, no, just go ahead and calculate it, and then we'll take a look. So really, how much of it's deductible? All of it? No, because 40% of it's really child support, isn't it? So only 60% of those monthly checks are going to be taxable or deductible. Times 12, right? Because I asked for the annual amount. So $12,960 a year. Child support's never deductible and never taxable. And if you fall behind on your child support, everything that you pay until you get current with that is considered child support. In other words, if I fall behind on my child support but not my alimony, and then I pay you $1,000 next month, my ex-spouse, that's all considered child support, i.e. non-deductible, until I get caught up. Prizes and awards. A lot of people don't realize this, but if you get prizes or awards from your employment, or you win a game show, or you call into the radio and you get 2 tickets to go see Pearl Jam in Seattle, you get a 1099. Yeah, absolutely.
So what about like if I won $1,100 in Georgia playing?
That's gambling, and you get a 1099-G because, well, it's under $1,300.
Oh, okay. I think, like, I never got one, and I know they took all my information and, you know, everything when I won it. It was 1,100.
Wow. So you get fair market value of the property or cash. You're going to get 1099. You got to pay tax on that. The only exception is if your employer gives you tangible personal property, like here's a, I don't know what, this has kind of gone the way of the dinosaur, but you know, here's an iPad for your either length of service or your safety. Then up to $400 you don't have to pay tax on it, or up to $1,600 if they have a qualified plan in place, which means a plan that's compliant with the Internal Revenue Code. Game show, reality TV show people. I think one of the first winners of, what's the one where they go on the island,
Survivor.
vote each other off, Survivor. One of the first winners of that, I think it was the first or second season, was in Australia. And
Richard Hatch.
Yes, he was convicted and sent to jail because he didn't pay tax on his $2 million.
Really?
What a dork.
One
Like,
that was
probably
he
one of the
was
most
walking
highly
around naked on
publicized.
the beach the whole time, and he was weird. He was he was whack. Taxes for the least of that dude. Right.
I can't believe you remember his name.
Yeah. I'm sorry.
I think, me too. And I loved it because it was in Australia and we used to live there, and so that was fascinating to me. Okay, so, and Australia is, by the way, a very scary place. The world's most poisonous spider, most poisonous snake, biggest sharks, most poisonous octopus. There's crocodiles in the rivers. There's a lot of things to watch out for there. So this guy is an employee. He gets a clock for 20 years of services, valued at $1,500, and they don't have a qualified plan in place. How much of that $1,500 shows up on Joseph's tax return? $1,100. First $400 is tax-free. Right? First $400 is tax-free if it's for safety or length of service. First $1,600 is tax-free if you've got a plan in place. Okay, annuities and pensions, and then we're going to take a breather. An annuity is an instrument, financial instrument, whereby you give somebody, usually a trust company or a banker or a broker, a chunk of money, and they guarantee you a payment for life. Why would you do that? Mostly retirement age. So I saved my whole life. I have $300,000, and I take it to the trust company, and I go, here's my $300,000. Please send me a check once a month. The women in my family live old. I have an auntie that's 101. My mama was 93. My grandmas were both 97. So I'm like, great. I give them my $300,000, and if the odds are with me, I get a check every month till I die in my 90s. What if I get hit by a bus on the way home? All gone. There's none for your heirs. So they're taking the chance. How do they figure out how long they think I'm going to live? They go to mortality tables that the IRS gives you. And it's basically, are you a man or a woman? Do you smoke or not smoke? And that's the end of the story. And they plug how long you're projected to live based on that. Huh? Nope, there's 4 tables. Man, non-smoker, man, smoker. Woman, non-smoker, woman, smoker. Period, end of story.
So there's no fee paid?
Oh, sure, they make money off of this, but what they're doing is they're betting on the odds. You're going to die early, I'm going to die late, but, I have less money than you did, and they're going to earn interest off that too. And I'm going to earn interest off that. The question is, if I give them my 300 grand and they start sending me $1,800 a month, is that taxable? Why not? It was already your money. Some of it's a return of my money, but some of it is probably interest as income. And what if my employer put money into it? That's going to be taxable coming out. So it gets complicated pretty quick. Okay, here's the general rule. The payments you receive some are taxable, and some is just what Jess said, non-taxable return of income, return of capital, excuse me. I'm not going to get taxed on my own 300 grand I gave them, right? So what you have to figure out with annuities and pensions is how much am I excluding from income? And the first thing you need to figure out is the exclusion ratio. And that exclusion ratio is the investment in the contract, right, the 300 grand I gave him, divided by how much are they going to give me annually times how long do they think I'm going to live. So the portion that's excluded is the investment in the contract divided by how much am I getting annually times how long do they think I'm going to live. Once we have that percentage, then the ratio, you just multiply it by the amount that you're getting every year, and that's the amount that you don't have to pay tax on. So let's walk through one of these. My friend Din has saved $750,000 in his retirement account. And he uses it to purchase an annuity. And the annuity is pretty sweet. $4,800 a month for the rest of his life. The IRS tables show he's expected to live 19 years. And we want to know what percentage or what amount of that $4,800 a month, and obviously you have to annualize that, is going to be excludable. So start by finding the exclusion ratio, right? Investment in the contract divided by how much is the company estimating to pay him out over the course of the last 19 years of his life. Hi.
I didn't, it was it.
I think it was like $1 million.
Or you might even Craigslist. What's the numerator? Mm-hmm. Numerator, the investment in the contract, 750 grand. How much is he gonna get paid annually? How much is he gonna get paid annually? 4,800 times 12, right?
At least 7,600.
Yeah, that's his annual payout is 57 cents. How many years are they planning on paying that out to him? 19 years. So annual payout of 57.6 times 19 years. So you take the 750,000 divided by whatever that denominator turns out to be. And that is the percentage that's excludable, right?
Is it the percent of the total?
It's so every year when he gets his 57.6, the question is, how much is excludable? Really, a return of my own money. So 68.5% of everything he gets every year is excludable from tax. It's a return of his own contract.
So I multiplied it by 0.69.
I think that with annuities, you need to go out 3 places. Actually, I think you need to go out 4, but this one ends up nice and neatly at 3. When we go through these slides, by the way, if some of them are worked too fast, you have got to go back on your own when you can just kind of chill and wrap your head around it and work through them on your own. If your payment started after 1996, there's a simplified worksheet, and it's in your book. Where is it? Pages 212 and 213. I'm not really going to go through it, but I just want to show you where they are. And this really is what your software uses. Okay, employee annuities. This is when your employer has paid into the retirement contract. So in the example with Din, who had put the money into his account? He had. In this example, the employer funds it. So say he works for SG Long. They put in money over the course of his career. He accrues $750,000. Is that going to be taxable to Din when he takes it out? It's all going to be taxable. The employer is making periodic plans. They're not taxable to the employee during the course of his career when they're paying into it. But when he pulls it out, it's all taxable. Life insurance proceeds. Do you pay tax on life insurance proceeds? Nope. Viatical settlements. Who's ever heard of this? Viatical settlements. This was really big in the 80s. And this just shows how human beings capitalize on misery to make money, in my humble opinion. So what it is if I'm chronically or terminally ill, and I have a doctor says that I'm chronically or terminally ill, so chronically ill like I've got multiple sclerosis, or terminally ill like I have a brain tumor, I have sarcoma, I can take my life insurance policy and sell it, right? So I have a policy on my life for $300 grand. I'm only going to live another 8 or 9 months. Turns out I need money now. I take my $300,000 life insurance account or life insurance policy. I take it to you who buys them, and you give me 200 of the 3. And then when I die, you get the 3. So you're a broker, right?
So
That's
there's-
called a viatical settlement.
So there's companies that just buy.
Yes, they buy life insurance policies from chronically and terminally ill people at a discounted rate, and then they become the beneficiary, and when I die, you get the 300 grand. The story in the 80s is these things sprung up because of the AIDS epidemic. So lots of people were selling, you can come in, were selling their life insurance policies. But what happened in 1987? What was discovered? AZT, the people didn't die. Hi. Oh, great, beautiful, we need that. The people didn't die. So all these people had bought discounted life insurance policies on people that didn't die.
Yeah. Oh, wait.
Well, no, we got the AZT cocktail, and these people, they're still alive. So that was a little bit of a kerfuffle where people are calling, going, you were supposed to die. I got this policy. What happened? The point being is that if you were to do that, if you were to sell your life insurance policy and get a viatical settlement, it is excludable from gross income because it's just a prepay on your life insurance policy. Okay, this doesn't, I mean, I've never really seen this happen. I'm just going to give it a very cursory explanation. Actually, I'm not going to, just because we have enough things to worry about here without this. Okay, gifts and inheritances. If you inherit, do you pay tax on it?
Inheritance tax?
Nope.
Oh, it does.
Only if it's over, I believe it's 1.3 million.
Oh.
However, what if your grandparents gift you $20,000? Anything over 14 grand is taxable. So I can gift 14,000 per person per year. So if you guys were all my nieces and nephews and kids and siblings, and I'm elderly, and I've got a $2 million estate, what do I want to do? I want to start gifting it to get it under that 1.3 million. So I give you each 14 grand a year, no tax. Tax-free transfer of wealth. If I start gifting each of you 100 grand a year, 86,000 of that is susceptible to gift tax. The difference between 100 and 14.
How much is the gift tax?
The gift tax is the same rate as estate taxes. Like 35% is the highest marginal rate. So what's it trying to do? Preclude you from shifting your estate tax-free. True story. These are one of my kids' godparents. Folks were real entrepreneurial. They built up this chain of industrial dry cleaners. Then he goes to set his 20-something-year-old son up in a tire business in Colorado. And he buys the tire shop, and he gets the kiddo trained up in it, and then he gives him title to the tire shop. What did he just do? He gifted it, and they have an estate way more than $1.3 million. He got hit with 35% gift tax on the value of the tire shop. And his CPA got fired.
Right.
Oh, bad move. Don't ever gift or allow someone to gift you chunks of change, and it doesn't have to be cash, it can be property, without having a consult with a tax attorney.
So how should he have done it then?
He should have done it over time.
Just
He should have
like
done
stock in
it
the
over
company,
time.
worth 14,000 every year.
Absolutely, and that number goes up every year. For a long
Right.
time, it was 11
Right.
grand, then it was 12 grand, now it's 14,
Right.
maybe even 14.5. I don't know.
So just slowly give him bits of it.
Should have gifted it over time.
Can't they say they sold it?
Yeah, but where's the arm's length transaction? Sean never paid Joe the $500,000 that it was worth.
Well, even if they just claim to have sold it, wouldn't they have to pay taxes on the sale?
There would have been a capital gain from the father's aspect, yeah. But also, I mean, they didn't. And if an auditor comes in, they're going to say, well, where's the transaction, arm's length transaction? Scholarships. Do you have to pay tax on scholarships? Well,
Or room and board,
yes, only the amount that applies to room and board. So if you get scholarships for your fees and tuition, no tax. If you get it for room and board, tax. If you have to work to get part of the scholarship, i.e. work study, that's taxable income. That's really compensation. When you do your tax credits for American Opportunity Credit or Lifetime Learning Credit, right, which are higher ed credits, and say that your bill is $6,000 a semester, but your scholarship's $2,000, do you get to use the whole $4,000 towards the, or the whole $6,000 towards the credit? No, only the amount that was out of pocket, $4,000.
What if you get grants and, like your financial aid, how does that work?
Grants reduce the amount that you get to use for the credit. Loans are fully included because you're liable to pay that back. So say you have a $6,000 bill, you have a $2,000 scholarship, you have a $1,000 Pell Grant, and a $3,000 student loan. You only can use the $3,000 towards the calculation of the credit. Because the grants you don't have to pay back. Scholarships you don't have to pay back. Loans you do have to pay back. They don't care if you just pulled it out of your bank account or borrowed it.
Are you kidding me?
What if your employer pays your health insurance premiums? Is that taxable to you as they go? No. Nope. It is excluded from income for AD&D, which is accidental death and dismemberment, kind of gruesome. But you can buy policies where each of your limbs are insured. You know, your thumb's worth more than your pinky finger, and your wrist is worth more than your ankle. Those kinds of policies are called AD&D, accidental death and dismemberment. Most of us wouldn't have them unless we were in a high-risk occupation. I mean, I'm probably going to have a pretty small chance of dismembering myself at my job. But if I was, if I worked in a mine or with hazardous materials, or, I was an excavator or something, I mean, there'd be a high propensity maybe that I would be accidentally dismembered. Meals and lodging. What happens if your boss or your employer pays for either and or meals and or lodging? You're not taxed, but only if
If it's your employer's benefit.
that's exactly what the question is. Is it for the employer's benefit?
Right.
So DirecTV provides, they don't. I'm just kind of making this up. There's a discounter, which makes it a little bit more complicated. But say, okay, no, Google. Google has a fully functional cafeteria on their campus, right? So if you go to work for Google, and I mean, it's organic, it's kosher, it's halal, I mean, whatever you want, okay? Is that included in the wages of a Google employee? Yes or no? Is it for the employer's benefit or the employee's benefit? Not really. It's for the employee's benefit. It's one of the ways that they recruit there, along with providing pet insurance and on-site massages and dry cleaning and yoga and, wellness coaches. Well, it's a recruiting technique. Now, the example of something that would be for an employer's benefit is EMTs. Or I run a ranch up on the High Line and there's nowhere for my employees to lodge. They've got to come live at my ranch. That's the employer's benefit.
What about training?
Training this isn't really what we're talking about. We're talking about
If they lodge you to go to like a training.
if they send you to go to training in Cincinnati, that's a business expense for them and non-taxable to you. This is, so say that I work at Red Lion as a manager and they put me up in the hotel. Is that for their benefit or my benefit?
Are you managing the hotel that you're lodging in? Then it kind of be for their benefit.
It's probably for their benefit because I'm on site 24 hours a day.
Yeah.
So it's probably not going to show up on my W-2. But say that let's see, what's another example? Say that they just gave us meals here as faculty members here at Missoula College. Is that for their benefit or my benefit? That's for my benefit. So then it's going to show up on my W-2.
What if you, like if the company decided they wanted to send it to like another country and you're going to pay for like, say, $4,000 US towards your rent to live in this other country for a couple of years?
Okay, foreign income gets really complicated, and here's why. If you're a U.S. citizen and you're living in another country, you can make up to, and I don't know the exact number, it changes every year, I think it's around $92,000 a year tax-free. So when I lived and worked in Australia, and when I lived and worked in Denmark, I didn't pay any federal income tax because I made way less than $92,000.
So like when the RAs in the university housing, part of their compensation is they get their rent paid by the
Yep.
university. Is
Yep.
that something they have to pay taxes on?
Well, what do you think? Is an RA living in the dorms for the benefit of the University of Montana or for his or her benefit? Primarily. Yeah, I mean, I think you can make a case, obviously, for
They're in the
both.
dorm anyway.
Yeah. I think it's primarily for the university's benefit. They want somebody there on site 24 hours a day. So that is not going to be compensable wages. Now, with that said, I have no idea. There's probably something like that has been adjudicated in tax court because there's got to be thousands of RAs around the country. So something like that where there's a number of those like-kind situations, I can guarantee you that it's gone to tax court at some point.
Well, if it's required by your employer, it's just automatically for their benefit.
Yes. Yeah, you want to come be a ranch hand, you need to live at my place. Non-negotiable. Yeah, to be an RA, you've got to live in the dorms. Yeah, that's probably a fairly good way to adjudicate it. Okay, should we go and just take a quick stretch break? Okay, I'm going to turn this recording off and then we'll start another one.